I'm kind of smiling because the last time we had this conversation, the Australian dollar had fallen from $1.10 to about 95. And I think I said in the interview, the Australian dollar was going to 51 cents. And that seemed like a remarkable number, but there's nothing remarkable about 51 cents. We've been there many times before and we'll go there again. We are a cyclical economy. We are cyclical based on resources and commodities, and we're cyclical like every other economy. So we're actually halfway now. $1.10, we're at 73, 74. We're well on our way to 51 cents. And so in that environment, any asset held in overseas currency is going better than your Australian dollar, which is dropping another 20 or 30 or 35%. So the big ones for us, and this always makes people smile, is Macquarie Bank is 75% offshore earnings. So Macquarie continues to be a really good trend for wanting to buy offshore, even though it's listed in Australia. Our second biggest position is Luxottica, the global sunglasses business with 120 billion market capitalization. It's an Italian business. It's doing extremely well. And whilst many of the emerging economies may not be able to afford a new house or a new Mercedes-Benz or a new Apple computer, they will probably go out of their way to buy a new set of Ray-Bans. So it's a more affordable luxury item, and of course Luxottica is having phenomenal growth. The other one, which also makes me smile a bit, is Henderson. Henderson is 96% offshore earnings, and as many people that have been in the markets for a while would know, it's a spin-off of the AMP, and they're actually coming back to compete against the AMP now in Australia. And they're predominantly they are a global funds management business with huge diversification. So these are all stocks that go extremely well when the Australian dollar falls, but go well independently of that because they have really strong earnings growth and do trade on quite reasonable multiples relative to their growth.